60 marks of costing in just 60 minutes. Yes, you heard it right. Yes, everyone. So, hello, hi, namaskaram, my dear warriors. I hope you guys are doing really well. And welcome to Costing Rocket Revision Part 1. In this, we will be covering the following chapters: service costing, joint product by product, marginal costing, budgetary control, job costing, unit batch costing, standard costing, cost sheet, as well as cost accounting system in the same order. Now, this is going to be one of the most awaited videos for costing. So, for all the students who purchased our classes, we give them a rocket revision, wherein the entire subject revision we will be doing roughly in 1.5 hours. But I had not yet uploaded these videos on YouTube. But I felt because exams are close and you guys will benefit from this, I'll be uploading this. But one very important caveat. Now, understand the learning happens in different phases. First, we have the regular class, roughly around 170 hours, wherein every concept, every question will do. Then we have exam-oriented classes, roughly around 100 hours. Again, we'll be discussing the concept. Then we'll have a marathon. In a slightly very fast-paced way, we will be discussing the concept. Now we are having a rocket revision, wherein we are trying to cover the entire subject in 1.5 hours. That is, in 100 minutes, we are trying to cover 100 marks of the subject. It is not possible that I explain you the logics here. If you want logics, it is available in regular, exam-oriented. Even if you want, you can see the marathon, you'll get the idea of how conceptually I teach the subject. But here, explaining you the logic, deriving the logic is not possible. So then what you will be doing, I will just keep repeating the pointers. Formulas I'll quickly repeat. What all questions are there, what all adjustments are there, what all things you will have to be keeping on the back of your mind. Quickly I'll keep repeating. So that if you are a student who has already listened to the classes, maybe my classes or any other faculty's classes, yes, all those will come in a proper framework, and in the lowest possible time, you can quickly have a recap of all the portions. That is what we'll be doing. So the most important caveat is I am not explaining you guys the concepts. So if any student is coming here to see, okay, how Tabish sir is teaching, how Tabish sir is explaining, I'm extremely sorry, dear, you watch any other video. Here I'm not explaining things. If you want the most logical explanation, we do. The entire subject will do without even touching a single formula, but that will not happen here. Okay, yes. If you're having any doubts, now how you can use it is, suppose you're having less time before examination, quickly have a look at the rocket revision of a particular chapter. Any place you're having a doubt, you go back to the marathon, there you watch a detailed discussion or understanding on the same. Okay, and if you're a student, you want to purchase classes for CA intercosting, you can visit our website www.thinkwithtabish.com or contact 83102-46880. Now, who all and how to use? Now, if you are a student who has purchased our classes, then definitely in the same order, yes, the discussion is happening. So you can close your eyes and blindly, yes, listen to the rocket revision. Okay, now for others also, for a quick recap of the concepts, you want to understand one chapter, the gist of the entire chapter in 10 minutes, you can listen to that. Not necessarily 100% of the things should be clear, but you will get an overall idea. Based on that, you see, things will start making more sense. Or you've listened to a chapter once, you've studied a chapter once some time back, you want to quickly revise, you can use it. You're traveling, yes, you're having some 10-15 minutes, you don't want to waste that time. Yes, put on your earphones, listen to that. Yes, one chapter will get over in roughly 10 minutes. Is this clear, everyone? Yes, you can use it 1.5 days before your examination. Yes, you've revised the chapter. It's been a really long time. You feel that you're forgetting things. You can listen to it. Yes, on the day of examination, just 2 hours before you enter the examination. Yes, just listen to it. The entire subject will be on the grasp of your hands. Okay, for your cumulative revision, you can be using it. Yes, you can use it also as an audio revision. Okay, so anything you're doing, you're going out for a walk, you're going in the bus, you want a quicker audio revision, you can just plug into that, listen to that. So a lot of efforts has gone behind this. So do let me know how this resource is for you. If it is helpful, do share it to all your friends. Yes, do share it to all your friends. The files will be available on Telegram. Yes, to get the files, you can just visit our Telegram group, Think with Tabish. And do let me know how this resource was. Do let me know if you want a part 2 of this costing rocket revision as well. So that's all for this video. From here onwards, the rocket revision is going to start. So that's all. Happy learning, my dear warriors. Yes, everyone. So welcome to the second part of the revision. So second schedule, we've covered 9 chapters. So quickly, in less than 1 hour, let us try revising all the chapters. As much as possible, try recollecting. Okay, boss. So we started with the service costing. Coming to the world of costing, yes, costing is a systematic process of ascertaining the total cost. Yes, elements of cost is a direct material, direct labor, direct expense, overheads. Costing is required for existing goods or services, new goods or services. Existing goods or services, two objectives: cost ascertainment, cost control. New goods or services, decision. To ascertain my cost, we have different methods of costing: job costing, contract costing, service costing, unit costing, batch costing, process costing. For exercising cost control, we have two techniques: standard costing, budgetary control, and decisions are based on the concept of marginal costing. Quickly, let us try recollecting service costing. Service costing, it is a method of costing. When do I use service costing? We are providing services. What kind of services we are providing? Generalized services. I want answer for 3 questions. Question number 1, what is my total cost? Question number 2, what is my unit of measurement? Question number 3, how many units of goods or services are provided? Question number 1, what is my total cost? Data will be given. I have to add. While I'm adding, ensure that the data is uniform. One simple point for the entire chapter: ensure uniformity in data. Point number 2, sample cost sheet format. I will bifurcate my cost as standing, that is fixed, running, which is variable, and maintenance, which is semi-variable. But this is not required. Okay, boss. Second is, what is going to be my unit of measurement? Normally, composite units are used. It is more than one unit of measurement is used simultaneously. Yes or no, everyone? Perfect. So in case of hotel, what all factors are going to determine my cost? Number of rooms, number of days. What will I call it? Room days. Number of rooms into number of days. Passenger transportation service. Number of passengers, number of kilometers. I will be calling it as my passenger kilometers. Number of passengers into number of kilometers. Goods transportation is tons, number of kilometers. I will call it as my ton kilometer. Number of tons into number of kilometers. And we have our hospital is number of patients, number of days. I will call it as my patient days. Number of patients into number of days. I can also call it as a bed days, because number of patients, number of beds are going to be one and the same only. Okay, boss. Final point is, okay, while I'm dividing, yes, what should be my denominator? Point number 1, I should consider effective services only, because only effective service is going to bring me my revenue. Point number 2, if I'm providing more than one category of services, I should be considering my equivalent services. How do I calculate equivalent services? In the ratio of revenue. You can give the weight as 1, 2, etc. or you can give it as X, 2X in the ratio of revenue. Is this clear, everyone? Okay, boss. Perfect. Based on that, different industry we had seen. Okay, absolutely fine. Yes, one additional point we had to see in case of goods transportation is absolute ton kilometer and commercial ton kilometer. Absolute ton kilometer means exact. It means for every path, what is the weight, what is the distance, what is the weight, what is the distance, what is the weight, what is the distance. Commercial ton kilometer is an approximation. So I will tell total how much distance I have traveled into, on an average, what was the weight of goods we were holding. Is this clear, everyone? Perfect. Yes or no? So couple of questions quickly, small adjustments quickly. Let us try seeing in this chapter. Okay. Yes. How questions can come in service costing? One of the two. Either question is asking you to calculate cost, or question is asking you to calculate revenue. Question is asking you to calculate whatever it is. Step 1 is always to select a base period for which all calculations we doing. Everything has to be done for that period. Okay. Yes. Next. Yes, I will calculate the total cost for the base period. Okay, if question is asking me to calculate cost, I will calculate total cost for the base period. I have to divide by number of units. So I will consider effective units for the base period. If we are providing more than one category services, I will convert it into equivalent units. Yes, total cost divided by equivalent units or effective units, whatever the case be. I will be getting my cost per. Is this clear, everyone? Question is asking me to calculate revenue. Yes, obviously total cost plus profit gives me my revenue. Total revenue I got. Now I have to divide revenue per unit. I want to calculate. Okay, boss. Total revenue I got. I will calculate effective services. More than one category of services. Equivalent I will do. I will divide. I will get my revenue per unit. Is this clear? The entire chapter is just simple maths. 3rd standard maths. Is this clear, everyone? Okay, boss. Quickly we will try discussing. Pay attention. Yes, students who are watching it subsequently on YouTube. Yes, obviously, yes, question discussion I will not be showing, just the important adjustments I will be telling. Okay, try understanding as much as possible. Okay, boss. So we had questions in that we had seen. Question number 2 was there, wherein Question had told me that driver has to be paid, drivers and conductor salary, fixed amount is given, in addition to 10% of takings as commission. So what I did, total cost excluding that item, plus that item, gives me total cost, plus profit, give me revenue. Everything was given as a percentage of revenue. Revenue, I took it as X. Accordingly, I got my equation. I solved it. Is this clear, everyone? Okay. Then we had question number 3. Public school. 8 kilometer per side, senior, junior, morning, evening. Yes or no? So, morning. Yes, 8 kilometer one side. It will come back into 2. Yes, seniors have come. Again, juniors we have to pick. 8 kilometer, 8. So morning it is 8, 16, 24, 32. Evening same story, we have to drop them. Is this clear? So 8 kilometer per side into 2 times going and coming into 2 category of students into 2 times in a day. Is this clear, everyone? That was a very important point. Okay. And then where we divided total cost divided by months, I considered 12 months because even though school is running for 9 months only, yes, my fees is collected for entire 12 months. The last point was I got the cost for one bus. While I am dividing by number of students, I want number of students in one bus. 50 juniors were going, 50 seniors were going. That point should be kept in mind. Okay, boss. Next question that we had was in case of hotels. Case of hotels, okay, some simple questions were there. One question which was there is 100 rooms in a hill station was there. There my monthly electricity bill, yes, except in the 3 months of winter when it was 30 per room, something like that, one wordings was there. Question did not specify. My default assumption is winter comes in my off season. Is this clear, everyone? Okay, perfect. Hospital was there. Okay, I will be bifurcating contribution per patient day, BP. Now that we have understood marginal costing should be simple only. Is goods transportation. One tricky question is there. I will not be repeating it again. The revenue calculation, all those things were there. That's all. Every other question was somewhere or the other. You should be in a position to solve this. Is this clear, everyone? Service costing, one of the simplest chapters ever. And scoring as well. Every time, a question of 10 marks used to be coming previously. Now with the revised scheme, question of 8 marks should become. Is this clear, everyone? Yes or no? Perfect. Yes, everyone. So now let us go to the next chapter, which is going to be joint product byproduct. Okay, boss. Yes, joint product byproduct. It is an extension of process costing, where in a process, multiple products emerge. So how do I distribute my cost, common cost to multiple products? For that, we are having the technique of joint product byproduct. Simple example, look at the students. There is a process for which I have inputted, I have incurred a cost of 10 lakh. Yes, this cost is jointly incurred, wherein at a split off point, I am getting multiple products. After that, they are further processed and we get the finished product. Yes, now this cost that I am incurring till split off is called what? Called joint cost or cost up to split off, or it is also called as a pre-separation cost. This point, what is this point called? It is called as split off point, also called as separation point. After that, whatever cost I am incurring, yes, it is called as a further processing cost. Cost after split off, or it is also called as post separation cost. Now understand, yes, am I having any problem in this cost? No, boss, this cost I know exactly for which product it is incurred. What I want to know, this common cost, how do I distribute? For that, I want to understand whether my product is a joint product or a byproduct. Joint product means it is my main product. There is an intention to produce. Byproduct, there is no intention to produce. It is just incidental waste which is arising during the production of main product. So treatment, byproduct treatment is simple, boss. By selling byproduct, how much NRV I will get? Sale value minus expenses. Yes, that I will use to reduce my joint cost. Suppose total 10 lakh is my joint cost. I am telling one byproduct was there that I sold at 1.2 lakh, but further selling expenses of 20,000 was there. I will tell, okay, boss, I want to produce my main product. 10 lakh I had incurred, 1 lakh I have recovered. That means now 9 lakh should be recovered from my main product. 9 lakh is the cost of the main product. Is this clear? Okay, boss. Now I am having joint products. How do I distribute? First one is a physical unit method or average cost method. Yes, total joint cost I will distribute in the ratio of quantity. Is it a good way? No, boss, not a good way. So we went to sale value. When I'm telling sale value, which all sale value could be there? Either the final sale value, that is my final selling price into final number of units. Okay, boss. But final sale value, based on further processing also my value may change now. So for that I may come to my NRV. So what is NRV? It is a final sale value minus further processing cost. Better than that. Even one step closer we can come, which is a sale value at a split off point. It is going to be selling price at split off point into number of units at split off point. Now one very simple point we have to consider is while I am taking sale value method. A sale value is selling price into number of units. Should I consider number of units produced, sold? Produced I should consider. Why? Because my objective is to distribute the cost. And cost is incurred while I am producing, irrespective of whether I sell or not. Perfect, everyone. Reverse cost mechanism, wherein I tell, yes, from my total sale, I will eliminate my profit. I should be getting total cost. In that I eliminate admin, selling and distribution, I should be arriving at my factory cost. It is a cost incurred in the factory to produce my product. In that joint cost is there, further processing is there. Eliminate further processing cost, I should be getting my joint cost. In this ratio we will distribute. Is this clear, everyone? Okay, perfect. Yes. Then we also had a marginal cost method. Yes, wherein what we are telling is, yes, marginal cost method is telling joint cost you are having, boss. Bifurcate it as a variable cost, fixed cost. Variable cost, more units means more cost. So that means my variable cost, in which ratio I will distribute? I will distribute in the ratio of quantity. Fixed cost, it is incurred irrespective of whether you produce or not. So my fixed cost, I will be distributing in the ratio of contribution. If contribution is a negative for a product, for that product I will not distribute. Is this clear, everyone? Then I will obviously be doing my marginal cost sheet format. Understand, sale minus variable cost, contribution minus fixed cost is profit. Here my question does not end because my objective is to calculate the total joint cost. So I will tell in that how much joint variable cost is there, how much joint fixed cost is there. I will add and do this. Is this clear, everyone? Okay, boss. Which method to choose? Obviously, if method has specified, otherwise, yes, obviously, first reverse cost, but that right now we are not having any questions on that. Then comes sale value at split off, then comes NRV, then comes final sale value method. Okay, boss. Now, one more point is, should I sell the product at split off or should I further process my product? Okay, boss, how do we take that decision? Should I sell the product at split off or should I further process? I will see. If I further process, how much extra revenue I will get? If I further process, how much extra cost I have to incur? Marginal revenue versus marginal cost. Yes, that is the additional revenue from further processing versus additional cost of further processing. Additional revenue, how much extra I will get? I will see how much I will get after further processing versus how much I was getting before further processing. Tells me how much extra I will get by further processing. Additional cost of further processing will be available. Based on that, I will get the additional benefit. Benefit is there means we will further process, or else we'll tell no, boss, tata, bye bye, sell it, split off. Is this clear, everyone? Yes or no? So this was your chapter, joint product, byproduct. We've taken 6 minutes, giving you guys a 2-minute break. Yes, everyone. So the next chapter we are having is going to be marginal costing, a beautiful chapter. Yes, so first is going to be basics of marginal costing. So we told marginal costing 3 concepts: basics, basic formulas, special situations. Yes or no, everyone? First, basics. Yes, how do we take a decision? I will be comparing my marginal revenue versus my marginal cost. Yes, marginal revenue is greater means accept the decision. Yes, marginal revenue is lower means reject the decision. Yes or no, everyone? Then we told, okay, boss, what is a marginal cost? It is the extra cost to incur to manufacture one extra unit. Normally it is variable cost, but sometimes additional fixed cost will also be incurred. Okay, boss. Then comes concept 2, which is going to be my basic formulas. First, we have marginal cost sheet format. What is the format, students? Sales minus variable cost gives me contribution minus fixed cost gives me profit. Yes or no? First is a concept of contribution. What is a contribution? It is a net cash that I get by selling my goods or services. If I sell 1 unit, how much specifically I am getting? Selling price. How much specifically I should pay? Minus variable cost. Is this clear, everyone? Okay. Variable cost ratio, PV ratio. Variable cost ratio is telling, yes, my variable cost is how much percent of sales. Variable cost divided by sales. PV ratio is telling my contribution is how much percent of sales. Contribution divided by sales. Both of them are complementary. If you add, you should be getting 100%. Okay, boss. Break even point. Yes, at BEP, three things are happening. What is it? Profit or loss is equal to 0. That means total sales is equal to total cost. That means contribution is equal to fixed cost. How do we calculate? Yes, logically using the table we can do, but alternatively, BEP in terms of units is fixed cost divided by contribution per unit. In terms of rupees, it is fixed cost divided by PV ratio. Yes, if you want BEP in terms of percentage capacity, it is fixed cost divided by contribution at 1% capacity. Yes or no, everyone? Okay, boss. Then comes margin of safety. What is margin of safety? It is my sale in addition to BEP sale. After BEP, how much I've done? Okay, boss. Now tell me, total sale I can bifurcate as a BEP sale, MOS sale. BEP sale as a percentage of total sale, it is a BEP sale ratio. MOS sale as a percentage of total sale is my MOS sale ratio. Both are complementary. You add, you should be getting 100%. Yes or no, everyone? Okay. Next point that we discuss, till break even point. Am I earning any profit? No, boss. That means my profit is 0. That means the entire contribution that I'm earning will be used to pay what? Fixed cost. So my contribution will be equal to fixed cost. Now, after BEP, I've reached MOS. I've already recovered my fixed cost, kept it aside. Now tell me, should I need to worry about my fixed cost? No, boss. That means in MOS, my fixed cost is equal to 0. That means whatever contribution I will earn will be what? It will be equal to my profit. Is this clear, everyone? Sales to achieve a desired profit or loss. I want to achieve 1 lakh profit. Whether 1 lakh contribution is sufficient? No, boss. I should first recover my fixed cost now. So it is fixed cost plus desired profit divided by contribution per unit, or is your PV. Is this clear, everyone? Then we had discussed the magic box approach for us to solve all the questions. Yes, we told simple thing that we want first 3 columns should sales minus variable cost is contribution minus fixed cost is going to be profit per unit data percentage. Selling price per unit, variable cost per unit, contribution. Total fixed cost you can write here. Percentage, sale is always 100%. 1% you get, other percent you will be in a position to get it as balancing. Okay, if question is asking you to calculate BEP, know that profit is 0. That means whatever fixed cost I have to pay, that will be the contribution. MOS means, yes, here fixed cost is going to be 0. That means how much ever profit you want, that much only contribution. Is this clear, everyone? Question asks you total sale to achieve a desired profit or loss. Yes, for your desired profit, add your fixed cost, you will arrive at desired contribution. Compare with your contribution per unit or PV ratio. Your data will be there either left, right, up, down, one of the 4 places. You have to see. But a very important point is just do not draw this table and come in the examination. Every key calculation, I should show it below as a separate working. Formula is not needed, but those numberings are going to be important. Is this clear, everyone? Okay, boss. Concept 2 is over. Then comes concept 3, which is going to be special situations. In that, first one is a cash BEP, cash break even point. Fixed cost can be bifurcated as cash fixed cost, non-cash fixed cost. I want to know, to recover my cash fixed cost, how much sale I should be doing. So it is a cash fixed cost divided by contribution per unit or PV ratio. Perfect. Graphical representation, not important. Differential formulas, 2 different levels are given. 2 observations we should be having on the back of our mind. First, change in total cost is nothing but change in variable cost, because fixed cost is not changing, boss. And change in contribution, suppose my contribution has increased by 2 lakh. It means my profit has also increased by 2 lakh, because again fixed cost is not changing. Is this clear, everyone? So derivation of formulas, variable cost ratio, simple formula, it is variable cost by sales. I can also say change in variable cost by change in sales, and I know change in variable cost is nothing but change in total cost. So it is a change in total cost divided by change in sales. Perfect. PV ratio, it is a contribution divided by sales. 2 different levels, change in contribution by change in sales. Yes, I can say it is change in profit divided by change in sales. Steps to be followed. Step 1, calculate PV ratio as well as variable cost ratio. Based on that, step 2, put in any one of the data, calculate fixed cost. Once this data you've got, now anything in the world you can do, yes, calculate whatever the question is asking. Is this clear, everyone? Okay, boss. Yes, Maja is coming. Mind ding ding happening. Yes, try focusing. Multi-product break-even point. I'm selling more than one products. So my fixed cost is not just recovered from one product, multiple products. So what I should be doing? Simple example we had of mobile laptop total. Yes. Now understand, look at this in terms of steps. Tell me BP, normal BP formula in terms of units. What is the formula? It is fixed cost divided by contribution per unit. But boss, I'm selling more than one unit, na? So should I be taking contribution of mobile? No. Laptop? No. What I want the composite contribution per unit. Okay, that means step number 1, I will calculate composite contribution per unit. Total in one bundle, how much contribution I got? Total in one bundle, how many units I had? So it is total contribution in the bundle divided by total units in the bundle. I will get my composite contribution. Perfect. Step 2 is denominator I got, fixed cost I know. Calculate BEP, which is fixed cost divided by composite contribution per unit. Yes, I will get in terms of units. It is the total units to be sold. I want the individual quantity. I will distribute the total quantity in the ratio of respective sale quantity. Yes or no, everyone? Okay, boss, perfect. I want BP in terms of rupees. What is going to be the formula? It is fixed cost divided by PV ratio. Yes or no, everyone? Multiple products I am selling, that means which PV ratio I want? Composite PV ratio. Step number 1, calculate composite PV ratio. Tell me PV ratio formula. It is contribution by sales. So composite PV ratio of the bundle, it is a total contribution of the bundle divided by total sales of the bundle into 100. Okay, boss. Once I get this, step number 2 is BP, fixed cost divided by composite PV ratio. I will get the total sale value. Total sale value I should distribute in the ratio of respective sale value. Is this clear, everyone? Perfect. Okay. Next is a limiting factor. What is a limiting factor? Any factor is a limiting factor whose availability is less than the requirement. How much requirement is there? Suppose 10,000 hours is required. If 10,000 hours is there, no tension. Available is only 6,000 hours. Shortage is there, was limiting factor. In case of limiting factor, how do I take a decision? Step 1, calculate contribution per unit. Selling price minus variable cost. Step 2, calculate contribution per limiting factor. Is contribution per unit divided by limiting factor. Okay, boss, once we do this, contribution per limiting factor I got. Based on that, give your rank. And based on the ranking that we have given, allocate the resource. Is this clear, everyone? A very important point. If a minimum demand has to be fulfilled for any product, first, out of total resources, fulfill minimum demand. Because that we already committed. For the balance resources only in the basis of rankings distributed. We had seen a question, 210 hectares of land, wheat, rice, maize, yes or no? So same point, minimum, yes, requirement should be first fulfilled. Next is cost indifference point, cost break even point. Two options are there. In one option, variable cost is less. One option, fixed cost is less. Which option should I go for? Cost indifference point. What is cost indifference point? It is the point at which total cost of both the alternatives is same. How do I calculate? It is difference in fixed cost divided by difference in variable cost. How do I take my decision? Draw a simple line. Assume, yes, in our example, petrol vehicle was there, EV was there. EV fixed cost is more, variable is less. Yes or no? Petrol fixed cost is less. Petrol fixed cost is less, EV variable cost is less. Assume your usage is very less. Assume you are not using only. Which one you should go for? Alternative where fixed cost is less. Assume your usage is very high. Which one you should go for? Alternative where variable cost is less. And where do we switch? At our cost break even point. Is this clear, everyone? Okay. If we are having three options, A, B, C. Step 1, calculate cost BP for the respective pairs. A and B, B and C, A and C. Then how do I do a decision? Draw a line. Yes. First, left extreme, what I'll be having? Yes, usage is lowest. Alternative with the lowest fixed cost. Usage is highest. Alternative with the lowest variable cost. In between the two, I will be having my balance alternative. Is this clear, everyone? Okay, boss. Then comes my shutdown point. I am running my business, but business is not good. So should I continue? Should I discontinue? If I continue business, what is the benefit? For every unit sold, I will be getting contribution. If I discontinue business, what is my benefit? I can save some fixed cost. So shutdown point formula is savings in fixed cost divided by contribution per unit or PV ratio. So how do I take a decision? Yes, my sale is very less. Shut down your business, go home, sleep. Yes, sale is higher than shutdown point. Continue your business. Is this clear, everyone? And if change in cost is given, so many places, marginal costing, budgetary control, we've solved so many questions. Variable cost per unit is constant. That means if question has given me change in variable cost, change I will be showing on per unit basis. Fixed cost on total basis is constant. That means if question is asking me change in fixed cost, I will be doing on total basis. Is this clear, everyone? Okay, perfect. Yes, then we had marginal versus absorption costing. Yes, obviously from an examination perspective, not that important, but still quickly in 1 or 2 minutes, let us try seeing. Okay, boss. There are two approaches to costing: marginal costing approach, absorption costing approach. Why? What is the objective? Tell me, students, marginal costing approach. Why am I having marginal costing approach? Decision making. Absorption costing approach is to calculate the total cost. That means in absorption costing approach, all product cost, all production cost will be treated as product cost. It is a variable production cost plus fixed production. In marginal costing, only variable production cost will be treated as my product cost. Fixed production cost I will not be treated. Is this clear, everyone? Okay, boss, perfect. So profitability statement as per marginal costing, look at this, everyone. So we have done this bifurcation: production, admin, selling and distribution. To produce in the factory, what all I'm incurring? Direct material, direct labor, direct expense gives me prime cost. Add factory overheads, could be variable, fixed. Non-production, admin overheads, variable or fixed. Selling and distribution could be variable or fixed. Yes, for my production cost, in marginal, only variable I will be taking as my product cost. In absorption, all I will be taking. In my non-production cost, in marginal, bifurcation of variable fixed is needed because I should calculate contribution. Absorption, that is not needed. Is this clear? Profit statement as per marginal. Simple approach. What is it, students? Sales minus variable cost is contribution, minus fixed cost is profit. Fixed cost, which all is there? Sir, fixed production cost, fixed administration cost, fixed selling and distribution cost over variable cost. Product cost could be there. What will I be calling my product cost? Cost of goods sold. Non-product, in that variable admin, variable selling and distribution. Yes, cost of goods sold. I want the cost for the goods sold because I'm calculating profit, matching concept. How do I get the cost of goods sold? It is opening stock plus production minus closing stock. If opening stock is also there, production is also there. Last period, different cost. Yes, everyone. So cost of goods sold, it is opening stock plus production minus closing stock. Opening stock is at a different price. Production is at a different price. Nothing is given. A default method of valuation is FIFO. So first opening stock will be sold. That means closing stock will be from the current period production. Is this clear, everyone? Okay, that is marginal costing approach. Absorption costing. Tell me, in absorption, do I want a contribution? No, boss. What is my, yes, overall structure? Sales minus total cost is profit or loss. Okay, in my total cost, I will first show my product cost, which is cost of goods sold. Then I will show my non-product cost. In that admin overheads is there, selling and distribution. Variable or fixed does not matter. I will be showing. Now it is absorption costing. I would have absorbed my fixed production cost. So the overhead absorbed could be more or less. Accordingly, I will be having under or over absorption. Under absorption, I have absorbed less, add it to cost. Over absorption, I have absorbed more, reduce from cost. Is this clear, everyone? And then we are having a reconciliation. Yes, whenever we are doing reconciliation, I will start with profit as per any one approach. I will end with profit as per other approach. Reason is going to be the difference in my stock valuation, opening as well as closing stock. Is this clear, everyone? Yes, perfect. Then the last point is number of units produced and sold is going to be lower of my production, demand as well as production capacity. Is this clear, everyone? Yes or no? So reasonably somewhere around 15 minutes we have taken. Take a 2 minutes break. We will continue further. Yes, everyone. So now let us go ahead to the next chapter, which is going to be budgetary control. Shh. So three concepts: fixed and flexible budgets, functional budgets, budget ratios. Yes, fixed and flexible budget. Fixed budget means I'm preparing a budget for one level. Flexible budget means I'm preparing budget for varying levels. There is absolutely nothing to be understood. Simple marginal costing basis. Variable cost means per unit should be constant. Based on that, I will calculate. Fixed cost means total should be constant. Based on that, I will calculate. Semi-variable means per unit is also fluctuating, total is also fluctuating. I will bifurcate it further as how much is variable, how much is fixed. How do I calculate the variable component of semi-variable cost? We have a very simple formula. It is a change in total cost divided by change in units. That gives me the variable portion. Balance amount is going to be my fixed cost. Is this clear? If question has given you change, that means for variable cost change on per unit basis you will be doing, fixed cost change on total basis we will be doing. As simple as that. Okay, boss. Then comes a very important point, which is functional budget. First, let us understand the actual flow. If I reverse it, I will get my budgeted flow. In reality, how transactions happen? What will I be doing first? Raw material purchase. They will come to stores. From there, what happens next? Raw material consumption. They are sent to factory. In factory, what am I doing? Production of finished goods. Okay, once goods are produced, what I will do? Sale of finished goods. Once my finished goods are sold, what will I get? Profit I will get. This is the actual flow. Budget is going to be reverse of actual. Where will I start with? I will start with the budgeted profit in mind. To earn a profit, what I should do? Sales I should do. So first budget is sales budget. If I have to make sales means what I should do and keep before? Production I should do and keep before. Based on that, I will prepare my production budget. In order to produce, what I should have done? Raw material should have been consumed. They should have been issued to the factory. Raw material consumption budget. And in order to consume my raw material, what I should do? I should purchase my raw material. Is this clear, everyone? Okay, these budgets, let me first finish it off. Yes, sales budget. Sales is in terms of quantity as well as value. Purchase again quantity and value. Everything else is quantity. Sales I am doing. Normally marketing team will give me. I will understand how much quantity I am selling, what price I am selling, what is my sale value. Production. How do I get my production? Yes, it is a sale plus closing stock of finished goods minus opening stock of finished goods. Okay, great, boss. Raw material consumption budget. Okay, for that, how much raw material we are consuming? It is going to be, yes, production of finished goods. How many units I am producing into raw material required per unit of finished goods. Say for example, 5,000 units have to produce. For every unit, 2 unit raw material is needed. So 2 into 5,000, 10,000 raw material has to be consumed. Yes or no, everyone? Perfect. And then comes raw material purchase. It is going to be raw material consumption plus closing stock of raw material minus opening stock of raw material. I will arrive at my raw material purchase in terms of quantity. If I multiply by the purchase price, I will get a raw material purchase in terms of value. These are my main budgets. Obviously, in functional budget, whenever I'm getting stock adjustment, closing stock is always add, opening stock is always less. Okay, other budgets, wages budget I'm having. Based on production, to produce, just raw material is not sufficient. Wages is also needed, expense is also needed. Wages budget, it is based on production budget only. I will understand how much hours should be worked, and for that, how much cost I should incur. I will see how many units I have to produce into. To produce 1 unit, how much time I want, gives me total how much time I want. Into, for 1 hour, how much rate I have to pay. We will understand total how much wages we should be paying. Is this clear? Expense budget, all your expenses you just add. Cash budget means I will start with opening cash balance, how much cash is received and how much cash is paid less. I will arrive at my balance. If I feel I want more money means I will borrow, again I will get money. If I feel I have more money means I will invest, again money is going out. I will arrive at my closing budgeted cash balance. Master budget is a master summary budget of all those. If a question comes, sales will be given, cost will be given, reduce, calculate the profit. Story is over. Perfect. A very important point. If a question is giving multiple product or multiple raw material or multiple labor, sales budget, what am I selling? Finished goods. Production budget, what am I producing? Finished goods. So if I'm having 2 or more than 2 finished goods, For every category of finished goods, I should prepare sales budget. For every category of finished goods, I should prepare my production budget. Raw material consumption and purchase is happening for raw material. If I'm having more than one category raw material, my consumption as well as purchase budget be prepared for every category of raw material. If I'm having more than one category of employees, my wages budget has to be prepared for every category of employees. Is this clear? Simple structure for us. Whenever I'm having more than one category, in every column you put that category. Based on that, prepare your budget. Is this clear, everyone? Okay. So concept 2 is over. Budget ratios, obviously with standard costing we will be discussing. So with this, the chapter budgetary control is also over. Take a 2 minutes break. We will continue. Yes, everyone. So next we are having two very simple JGB chapters: job costing, batch costing, output costing. Very simple JGB. Yes, job costing. I want to calculate cost of a job. Special thing here is every job is going to be different. That means I have to do calculation for every job separately. Question can ask me to prepare a cost sheet for a job. Yes, I will do direct material for the job, direct labor, direct expense. I will arrive at prime cost for the job. Add factory overheads, admin overheads, selling and distribution overheads. I will arrive at total cost for the job. Add profit. I will arrive at the sales for the job. Story over. Batch costing. Goods are produced in batches or in lots. One very important point is every unit in a batch is identical, because same time they are getting produced, same raw material, same set of employees, same machines, same working conditions. So if one item in a batch is right, every item is right. One item in a batch is wrong, every item is going to be wrong. So two type of question can be asked. Type 1 question is to prepare a cost sheet for a batch. How do I prepare? Simple. First, every calculation I will do for a batch. Direct material, direct labor, direct expense for a batch. I will arrive at prime cost for the batch. Add factory overhead, admin overhead, selling and distribution. I will arrive at total cost for the batch. This is a total cost for the batch. Say example 10 lakh I incurred. It is for 100 units. Tell me whether every unit in a batch is identical. Yes, boss. So I will do total cost in a batch divided by number of units in a batch. I will arrive at my cost per unit. Is this clear? Output costing, anyways, it is not relevant here. In cost sheet, the detailed cost sheet with adjustments we are having. Is this clear, everyone? Okay. The next concept that we are having is going to be the concept of EBQ, economic batch quantity. Yes, while I am having a raw material, I should purchase. How much quantity I should purchase in one order? EOQ. Finished goods, we have to produce. How much finished goods should I produce in a batch? EBQ. While I am producing finished goods, 3 costs I am incurring. What all? Production cost, setup cost, carrying cost. Our objective is total of the 3 costs should be minimum. Okay, boss. Annual demand of finished goods. It is nothing but batch quantity into number of batches. In one batch, how much I am producing? Into like that. How many batches I produce in a year? Tells me total how much I am producing in a year. So if I want my number of batches, it is nothing but annual demand of finished goods divided by batch quantity. Total how much I want divided by one time how much I am producing tells me how many times I should produce. Okay, boss. Production cost, it is a cost incurred to produce the finished goods. It is production cost per unit into total units. That is my annual demand of finished goods. It will be same only, irrelevant for decision making. Setup cost, cost incurred to set up my machinery. Is simple. It is cost per setup into number of setups, where number of setups is equal to number of batches is equal to number of production runs. How do I get that? Total how much I want divided by one time how much I am producing. Annual demand of finished goods divided by batch quantity. Suppose 10,000 I want, every time 5,000 I am producing. That means in 2 batches I should produce. That means 2 times I should be setting up. Is this clear, everyone? Setup cost is going to be downward slope. Next, I'm having carrying cost. Simple formula: carrying cost per unit per annum. To hold 1 unit for 1 year, what is the cost? Into average inventory. On an average, how many units I've held throughout the year. Carrying cost per unit per annum is normally given as a percentage of production cost. Average inventory is going to be batch quantity divided by 2. Carrying cost is going to be upward slope. Yes. Carrying cost is upward sloping, setup cost is downward sloping. The point at which both meet is going to be my EBQ. Based on that, I can derive my formula. EBQ is square root 2 DS divided by C, where D is the annual demand of finished goods, S is the setup cost, that is cost per setup, C is the carrying cost per unit per annum of my finished good. Is this clear, everyone? Obviously, question may ask you optimum runs, optimum number of batches, optimum number of setups. That is number of setups or number of batches or number of production runs at EBQ. Total how much I want divided by in one batch how much we are producing. Okay. Time gap between two runs or two batches. Suppose in 1 year 10 batch I am producing. That is in 365 days 10 batch. One batch is how much? It is 365 days or 12 months or 52 weeks divided by number of batches. Is this clear, everyone? Chapter is over. One of the simplest of the chapters. Yes, everyone. So the next chapter we are having is a very important chapter, which is going to be standard costing. It is a technique for cost control. Altogether 4 variances: material, labor, variable overhead, fixed overhead. Aram se one by one. First, let us understand material cost variance. Let me define my material cost. What is my material cost, students? It is a quantity into price. How much quantity you purchase into at what price you purchased. Okay, boss. Only the names, let us try recollecting. Overall change is going to be material cost variance. Change in price is going to be material price variance. Change in quantity is going to be material usage variance. Further analysis, you have sub usage or yield variance, purely change in quantity. Mix variance, purely change in mix. Aram se we will do. Material cost variance, always my comparison is going to be standard minus actual. So it is a standard cost minus actual cost. How do I get my cost? Quantity into price. So standard cost is standard quantity into standard price minus actual cost is actual quantity into actual price. Perfect, sir. In that, first, what will I nullify? The impact of price. Price variance, what is changing? Price is changing. Convert it into value. Price has to be multiplied with quantity. Which quantity? Actual quantity. Why? Because purchase manager is buying. He doesn't know standard quantity. His only responsibility is the entire actual quantity he should purchase at the correct price. Yes or no, everyone? Perfect. Now, once the price variance is nullified, now onwards, will I be using actual price anywhere else? No, boss. What price I will be using? Standard price will be my multiplier everywhere else. Usage variance, what is changing? Quantity is changing. It is a difference in quantity, convert it into value into standard price, which is standard quantity minus actual quantity into standard price. Further analysis I will be doing. Yes, I have my standard quantity, I have my actual quantity. In between, I will bring in my revised standard quantity. First two I compare sub usage. Next two I compare mix. So sub usage is SQ minus RSQ. I got the difference in quantity, convert it into value into SP. Mix is going to be RSQ minus AQ, convert it into value into SP. Is this clear, everyone? Additional point, standard quantity is the standard quantity for actual output. Standard means it is for actual output. Is this clear, everyone? So one default adjustment in every question is going to be to calculate standard quantity. Question will give you 2 or 3 raw materials are there. Their budgeted percentage it will be given. Yes or no, everyone? Perfect. So I'll tell total random 100 I will be taking as total input. Percentage I'll put. Standard normal loss will be given. I will arrive at my output. But in reality, I produced. Actual output is given. Standard is the standard for actual output. Is this clear, everyone? Oh, perfect, boss. Actual quantity means it is also the actual quantity for actual output. It means to produce actual output. Tumma purchase is sufficient or should we consume? Consumption is needed. How do I arrive at consumption? Opening stock plus purchases minus closing stock. Now, if I am having more than one actual price, opening stock is at a different price. Current period purchase is at a different price. Is what I will do. Instead of using multiple actual price and complicating, I will convert it into actual cost. Based on that, I will solve. So basically here, actual quantity into actual price, I will write it as actual cost. Price variance, standard price minus actual price into actual. We'll write it as standard price into actual quantity minus actual price into actual quantity is actual. That way the need for actual price is eliminated. Is this clear, everyone? Perfect. Revise the standard quantity. It is my total actual quantity in my standard mix. When I'm taking quantity, I want my input data. Yes or no, everyone? Perfect. That is material cost variance. Next, we are having labor cost variance. First, let us define our labor cost. What is labor cost, students? Is hours into rate per hour. How many hours we worked into for every hour, how much we are paying. Without idle time, with idle time. We will discuss with idle time only. Okay. The only point of difference for us doubt could be actual hours paid, worked. What is a simple thing we told? First two is paid. Third is a difference between paid and worked. Balance is going to be worked. First, let us derive all the names. Overall change is going to be labor cost variance. Change in rate is going to be labor rate variance. Change in hours, it could either be idle time or efficiency. Efficiency, further analysis, sub efficiency or yield. This side I'm having mix or can. Name is okay, okay boss. Labor cost variance, overall change in cost, which is a standard cost of labor minus actual cost of labor cost, hours into rate. So it is standard hours into standard rate minus actual hours into actual rate. Actual hours paid, worked. First two is paid. Okay. Then comes rate variance. Overall change. First rate I will nullify. Rate variance. What is changing? Rate changing. Difference in rate. Convert it into value. Rate has to be multiplied by hours. Which hours? Actual hours. Yes, which actual hours? The entire actual hours for which payment is being made. If I am paying extra for the entire actual hours for which payment is being made, it is a mistake of HR manager because he recruited at a higher rate. Is this clear, everyone? Here, rate I nullified. It means thereafter, anywhere I will get a rate. Which rate I will be using? Standard rate only I will be using. Idle time variance. What is the reason? Abnormal idle time. It is idle time hours, convert it into value. Hours has to be multiplied by rate, standard rate. Yes, idle time hours, it is nothing but actual hours worked minus actual hours paid into standard rate. It is always going to be adverse for the organization. Then comes efficiency variance. It is difference in hours, convert it into value into standard rate. Difference in hours is nothing but standard hours minus actual hours into standard rate. Actual hours is going to be worked. Yes or no, everyone? Yes, further analysis, I have standard hours, I have actual hours worked. In between the two, I will bring in my revised standard hours. First two is sub efficiency, next two is mix. Multiplier is going to be standard. Is this clear, everyone? Perfect. Yes or no, everyone? Okay. Then standard hours means it is the standard hours for actual output. Revised standard hours means it is my actual hours worked in the standard mix. Is this clear, everyone? Labor cost variance. Then comes variable overhead cost variance. How have we defined our variable overhead cost? It is hours into recovery rate per hour. Yes or no, everyone? Simple, three formulas are there. Overall change is variable overhead cost variance. Change in recovery rate is budget or expenditure variance. Change in hours is efficiency variance. Overall change, it is a standard cost minus actual cost. Standard cost is SRR per hour into standard hours. Actual cost is ARR per hour into actual hours. Okay, in that first, which one I will nullify? The change in recovery rate, variable overhead, budget or expenditure variance. What is changing? Recovery rate is changing. So it is a difference in recovery rate. Convert it into value, hours, which hours? Entire act. Here, the impact of recovery rate I have nullified. That means now onwards, anywhere recovery rate will come, I will be using SRR. Now I am having efficiency variance. What is changing? Hours is changing. So it is difference in hours converted into value into SRR per. Whenever it comes to overhead variances, step one is always a calculation of recovery rate, standard recovery rate. Standard recovery rate per hour, it is budgeted overheads divided by budgeted hours. At the start of the period I'm doing is per unit, it is going to be budgeted overheads divided by budgeted. Yes or no, everyone? All my variable cost together, if I'll have to tell, means two simple points. Point number one, I should be defining my cost. Material quantity into price. Labor hours into rate. Variable overhead hours into recovery rate. Overall change I will be taking, which is nothing but standard cost minus actual cost. In that first, which I should nullify. In case of material, price, external payment. In case of labor, rate. In case of variable overhead, recovery rate. Here my multiplier will always be actual. Once this is nullified, for every other variance, my multiplier is always going to be standard. Story over. Is this clear, everyone? Okay, boss. Then comes my fixed overhead cost variances. Here budget is also going to be important. So first, let us try remembering all the names and one word associated. Overall change, fixed overhead cost variance. Co-bifurcations, fixed overhead budget or expenditure variance. What is changing? Cost is changing. Fixed overhead volume variance. What is changing? Output is changing. Volume further analysis. Calendar day is changing. Capacity, input hour is changing. Efficiency, output hour is changing. Okay, yes, perfect. Now comparison, we've created a very simple mantra. First and last, cost and efficiency, standard versus actual. Second, budget versus actual. Balance, actual versus budget. Aram say we will do first and last, that is cost variance, standard versus actual. Cost variance, what am I comparing? Overall change in cost, how I want it, standard minus actual. So it is a standard overhead cost minus actual overhead cost. Standard overhead, how do I get? It is SRR per unit into actual output minus actual overhead. First and last, efficiency. What is changing? Output hours is changing. How do I want the change? Standard minus actual. So it is a standard hours minus actual hours. I get the difference in hours, convert it into value, SRR per over. Next, second variance, budget versus actual. Budget or expenditure variance. What is changing? Cost is changing. How I want it? Budget minus actual. It is budgeted overhead cost minus actual overhead. All my balance is going to be actual minus budget. Okay, volume variance. What is changing? Output is changing. How I want? Actual minus budget. It is actual output minus budgeted output. I get the difference in units, convert it into value, SRR per unit. Calendar variance. What is changing? Days are changing. So it is actual working days minus budgeted working days. I get the difference in days, convert it into value, SRR per day. Capacity variance. What is changing? Input hours is changing. How I want? Actual minus budget. So it is actual hours minus budgeted hours, but for actual working days, because days should not change, I get the difference in hours, convert it into value, SRR per hour. Story over. Sometimes question may not be having calendar, so ignore it. So when you're doing capacity, it is SRR per hour into actual hours minus budgeted hours. Day information is not given. Is this clear, everyone? Okay, perfect. Now, how do we solve a question? Step number 1, basic data. Step number 2 is SRR calculation. Step number 3 is calculation. Story over. Basic data. Yes, I will be drawing 2 columns. Budget, actual, what all I want, overhead, hours, output, days. 2 additional information. Budgeted hours for actual working days as well as standard hours for actual. Step 1. Step 2 is calculation of SRR. Per unit, per hour, per day. Once these two I get, anything in the world we can calculate. Is this clear, everyone? Okay, boss. Perfect. Then what we are having is, based on this, we had also discussed our ratios, activity ratios. Yes or no, everyone? So let's quickly have a look at those ratios area as well. Yes, activity ratios. They are going to tell me the performance of an organization in the form of a ratio. Okay, boss. Now, which all ratios are there? Altogether 6 ratios are there. We have bifurcated them as main budget ratios, additional budget ratios. Now main 3 budget ratios, activity ratio, capacity ratio, efficiency ratio. These are just a ratio form of my variances. Is this clear, everyone? Simple point I have to remember, conversion. If my multiplier is SRR, then my budget becomes budget, standard becomes actual. Story over. Yes, everyone. So look at this. Activity ratio. It is a ratio form of volume variance. Volume variance, what I am comparing? Output I was comparing. It was actual output minus budgeted output. So ideally the ratio should be actual output divided by budgeted output. But sir, I don't want in the form of output. I want in the form of hours. Okay, boss, write it in terms of hours. Actual will become what? Standard. Budget will become what? Budget. So it is standard hours for actual output divided by budgeted hours for budgeted output. Okay, boss. Then I'm having my capacity ratio, also called as actual usage of budgeted capacity. Capacity ratio, capacity formula is I'm comparing actual minus budget, actual hours minus budgeted hours. Directly I can write actual hours by budgeted hours into 100. Efficiency, standard versus actual comparison, standard hours minus actual hours. That means it is standard hours divided by actual hours into. Relationship, yes, capacity ratio into efficiency gives me my activity ratio. Yes or no, everyone? Perfect. Now we are having additional ratios. Calendar ratio, days I'm comparing. Actual working days divided by budgeted working days into 100. Capacity usage, how much of my maximum capacity I've used. Denominator is always going to be maximum hours in the budgeted. Standard capacity usage ratio, how much of my capacity I am planning to use. Virat Kohli example, maximum in one day 10 hours he can do practice. He planned that tomorrow 5 hours he will do practice. 50% of capacity he planned to use. Standard capacity. Actual capacity usage ratio, actually how much we use. Because in the reality 6 hours he did training. 6 divided by 10, 60%. So standard capacity usage ratio, it is budgeted hours. How much hours we plan to do the work divided by maximum hours in budgeted period. Yes, actual capacity usage ratio is going to be actual hours, actually how much hours we worked divided by maximum hours in the budgeted. Is this clear, everyone? Perfect. Yes, now we will go ahead to the next chapter, which is going to be cost sheet. Yes, your favorite interesting chapter, very simple GGB chapter. Pay attention, everyone. Cost sheet, it is a detailed statement of cost. Okay, so quickly just the format we will recollect. Yes, so what all we are taking? Direct material, direct labor, direct expense gives me prime cost. Add factory overheads gives me the gross factory cost. It is a cost that I've incurred in the factory for this period. But boss, not all the costs that I've incurred in this period, goods are produced. So I have to do my work in progress adjustment. So what I will tell, less closing stock of work in progress, because cost is incurred in the period, but goods are not produced. So I have to eliminate that cost, less closing stock of work in progress. Add opening stock of work in progress. Cost I'm having only of this period. Opening stock, some cost was already incurred last year, so that goods have been produced. So add opening stock of work in progress. I will arrive at my net factory cost, which is a factory cost that I'm incurring for the goods which are produced. Now to produce the goods outside the factory also I will be incurring cost. 5 special costs are there. QRACP. Yes, Q stands for quality control cost, R stands for research and development cost, A stands for administration cost specifically for production. All these are cost I'm adding. Next, C stands for credit for recoveries. It is a recovery against cost I am reducing. Finally, P stands for cost of primary packing. I will arrive at my cost of production. It is the production cost for the goods produced. But was ultimately I want to compare sales with the cost. Sales is for units sold. That means cost should also be for the units sold. So I will do the adjustment of finished goods. Add opening stock of finished goods. Already it was there. Less closing stock of finished goods. Even though it is produced, it is unsold. I will arrive at my cost of goods sold. Is the production cost for the goods sold. For the goods sold, product cost I calculated. Production cost I calculated. Outside production also, administration overhead, selling and distribution overheads I will be incurring, and we will be arriving at the total cost of sales. Add your profit, you will arrive at. Is this clear, everyone? Yes, in case of a direct material, I want my direct material cost, which is consumption, opening stock plus purchase minus closing stock. Any incidental expenses we are incurring, we should be showing it here. Is this clear, everyone? This was the chapter cost sheet. So I hope both the things we have done is from 35, 45, 52, 17 minutes. Okay, fine, perfect. Yes, everyone, so we have one final chapter which is going to be cost accounting system. Altogether, 3 different concepts are there. First is non-integrated accounts, integrated accounts, reconciliation. Non-integrated accounts, accounts are not integrated. Which all accounts we are having? Cost accounts we are having, financial accounts we are having. Financial accounts separately we are maintaining, cost accounts separately we are maintaining. It means financial accounts separate profit, cost accounts separate profit. Is there a need for reconciliation? Yes, boss, different profit. Integrated account, both the books of accounts are integrated. Only one books of accounts I am preparing. That means only one profit I will be getting. That means, is there a need for reconciliation? No, boss, one profit only I am having now. Based on that reconciliation. Now, where will I be having my reconciliation? Only in non-integrated. Now, how do I do my reconciliation? Very simple thing in the process, boss. Yes, you can come up with a reconciliation statement. Now, you will start with profit as per one approach and you will end with profit as per other approach. Yes or no, everyone? Okay, perfect. So what could be the reason for reconciliation? Transaction is appearing in both the books. Value is same. Is there a need for reconciliation? No, boss. Transaction is there in both the books, but value is different. Reconciliation will come. Transaction is there in only one book. Reconciliation will come. Yes or no? So what I will be doing? I will start with the profit as per any one approach. Nothing is given means I will start with profit as per costing. I will end with profit as per the other. Simple BRS approach. I will see, yes, this impact. If it is income, credit side means it is increasing my profit. Accordingly, I will compare. If it is expense, debit side means it is decreasing my profit. Accordingly, I will compare. Just to compare on a standalone basis, you will be in a position to do your reconciliation statement. Question may also ask you to prepare a memorandum reconciliation account in the form of a table T format. Now profit if I am having means opening balance will be there in the credit side. Loss means opening balance in the debit side. Benefactor is increasing the profit, credit side. Decreasing the profit, debit side. At the end, I will be getting profit or loss as per the other approach. Is this clear, everyone? Perfect. This is my reconciliation. Absolutely, I feel there is no need. From 10th, 11th, 12th, we are doing BRS. Same thing is happening here. Yes. Then comes a very important thing, which is going to be non-integral account. For cost, which all accounts we have to open? Altogether 12 accounts we have to open. Yes, for material related things, raw material related things, which account we are opening? Stores ledger control account, also called as material control account. For employee related information, wages control account. For direct expense related information, direct expense control account. For factory overhead related, production overhead control account, admin overhead control account, selling and distribution overhead control. For all the cost we incurred. Now, is based on where we are incurring. In factory, what am I doing? Producing the goods. At that stage, in which stage goods will be in work in progress stage, work in progress account. Okay, once goods are produced, where it is transferred? Finished goods control account. Once the finished goods are sold, cost of sales account. This cost of sales will be transferred to costing P&L. Sale is there, it is also transferred to costing P&L. There I will be getting my profit or loss, which is again transferred dumped to my G. Is this clear, everyone? Simple, small transactions. Let us see. First, purchase of raw material. Goods are coming in. Stores ledger control debit, GLA credit. Yes or no? Wages I'm incurring. Wages control debit, GLA credit. Direct expense I'm incurring. Direct expense control debit, GLA credit. Similarly, overheads I'm incurring. Respective accounts debit, GLA credit. Now, from stores, say raw material is returned to supplier. Goods are going out. GLA debit to stores ledger. Goods are going. Goods are sent to factory for production. Work in progress. Work in progress. Goods are coming in. From where it is going out? Stores it is going out. Okay. Indirect material is going to the respective overhead account. Where it is going? Overhead account debit to stores ledger. Okay. Wages. Direct wages means where it is going? Work in progress. Debit wages control. Indirect wages means where it is going? Respective overhead account it is going. Those accounts overhead account debit to wages control. I'm not telling the full name. Direct expense where it is going? Obviously it will go to work in progress. Debit, direct expense credit. Now production overhead where it is transferred? Work in progress account. Yes or no? Work in progress debit, production overhead credit. Yes, in work in progress, in factory, finished goods are getting produced. Once it is produced, will I be keeping it there? No, boss, I will transfer it to warehouse, that is finished goods control account. Debit to work in progress control account. Okay. On my finished goods, I'm incurring my admin overheads. The admin overhead cost here, from here it is going here. Finished goods control account debit to admin overheads. In the finished goods which is sold is transferred to cost of sales. It is going to cost of sales account debit to finished goods control account. For the units sold, selling and distribution overheads I'm incurring. So from here it is going here. Cost of sales account debit to selling and distribution overhead. Cost of sales is getting transferred to costing P&L. Costing P&L debit to cost of sales account. Now sales, aram se. Sales I'm doing. Once I do my sale, what is my normal journal entry? Cash account debit to sale. Here it is GLA to sale. Yes or no? In my sales account by GLA. This sale should be transferred to costing P&L to costing P&L. Sales account debit to costing. Is this clear, everyone? Costing P&L. Sales I'll be having in the credit side. Cost I'll have in the debit side. Abnormal items will be there.
Yes, loss means debit, gain means debit, credit. Based on that, a differential will be my profit or loss will be transferred to GLA account. Is this clear, everyone? Okay, boss. Now, special one or two things to be kept in mind. Yes. Which all account will be having opening, closing balances? Normally, 4 accounts. Raw material stock, stores ledger. Work in progress stock, work in progress. Finished goods stock, finished goods control. Will be having debit balance. GLA will be having credit balance. But if in case under or over absorption we decide to carry forward, those accounts will also be having a opening balance. Now, under or over absorption treatment. Under absorption, 10 rupee, 30 I have incurred, only 20 I have recovered. 10 is going to be my under absorption. Yes, in the credit side will be less. Debit is more, credit is less. That means the simple journal entry is going to be under absorption debit to overhead control account. Okay, boss. If I'm transferring to costing P&L means costing P&L to overhead control, carry forward means carry it down. This is from exam perspective, not important. Over absorption means ulta it is going. Is this clear, everyone? Now, tell me, how do we understand in the question? Should we be doing to transferring to costing P&L or carrying it forward? Opening trial balance. If I'm having opening balance there, means I have decided to carry forward. Otherwise, I will be dumping it to costing P&L. Is this clear, everyone? Yes or no? Yes, loss of material or a deficiency in stock. Material has gone. Yes, if I treat it as abnormal loss means directly it will go to costing P&L. Normal loss means from stores where it will go production overhead. Through that, it will be going to my working process through the process of absorption of overheads. Is this clear, everyone? Perfect. Yes, next is integral accounts. A journal entry make a maximum. Yes or no? 3 simple points based on non-integrated accounts we have to tweak. Instead of GLA, the respective accounts I will be taking. Instead of costing P&L I will be telling. All those pure financial transaction, payment to creditor, received from debtors, which I was not showing in non-integrated, that also I should be showing. Is this clear, everyone? So with this, integral accounts is over. With this, the chapter is over. With this, the subject is also over. Yes, 1 hour, 6 minutes. So this is a costing. So we started with the world of costing. For one final time, the world of costing. Yes, everyone. Yes, where did we start? Costing. It is a systematic process of ascertaining total cost. Introduction to costing. Then we discuss elements of cost. Direct material, direct labor, direct expense, overheads. Yes, overhead 2 method of distribution: absorption costing, activity based costing. Based on my element of cost, I can prepare my cost sheet, as well as for all of this, I want my cost accounting. Costing is needed for existing goods or services, new goods or services. Existing goods or services, 2 objectives: cost ascertainment, cost control. To ascertain my cost, we have 6 methods: job costing, contract costing, service costing, unit costing, batch costing, process costing. Process costing extension is JPBP. Cost control, it is going to be standard costing, budgetary control. New goods or services, we should be taking decision. Decision is based on the concept of marginal costing. This is our world of costing. This is where we started. This is where we ended. Is this clear, everyone? Perfect.